Hey, welcome to this Forex trading tutorial. Actually, this lesson I'm showing you on Forex, but this actually applies equally to stocks and commodities, futures, E-minis, whatever, anything you can chart. So this one is about trend and some of the little distinctions that people don't understand about trend. For example, one of them is that people are often taught, and I'm just going to freehand this here with this little drawing tool. They'll say, okay, trend is defined as higher highs and higher lows. That is incorrect. That is not right. Trend is not defined by higher highs and higher lows, or conversely, of course, by lower highs and lower lows. That is not a trend. Why is that not a trend? Very simple. Dictionary. The word trend is defined in the dictionary as the extended general direction. So, therefore, it means a long-term move. So, whatever you decide to use for measuring trend, whatever tool you decide to use, it has to measure the long-term move. Otherwise, it's not measuring trend. Now, here's point number 2. That has a downside. The fact that trend is always a long-term move, that then therefore makes it always a lagging indicator. Because before you can determine whether you have a trend or not, you need a lot of data. And once you have a lot of data and it plots it and it's confirmed, well, guess what? Yeah, you got a trend, but now it's always a lagging indication. And so trading trend alone is a very, very dangerous thing to do. In fact, a lot of professional trend traders, and I mean the people who actually make money doing it, often have a worse than 50-50 win-loss ratio. But they make money because they make up for it with an excellent reward-to-risk ratio because they're really good at keeping their losses small and letting their winners run. And that's great, and I respect them, but that's not, just doesn't suit my style. That doesn't work with my brain cells. I don't like that. So I've got to have, for me to be comfortable trading, I have to have a better than 50-50 win-loss ratio. So therefore, trend, yes, it is one of the things I look at, but acknowledging it's always a lagging indicator, I have to use other things too, so I use leading indicators with that. And by the way, if you're interested in that, I do have a webinar that I present periodically on my cycle indicator, and that is at times leading indicator. Nothing leads the market all the time, so there are no crystal balls in the market, but we're not predicting the future really, but mathematically there are times when you can determine a short-term move in the market before it shows up on price action. If you like that, just send me an email, Barry@TopDogTrading.com, and I will be happy to email you with the next time we're doing the cycle indicator. We usually do it once or twice a week, depending on when you watch this video, obviously. Okay, so anyway, so that's number 1 and number 2. Now, number 3 with trend is a little tricky. We're going to pick up on the first misconception, where now this isn't just about long-term direction. Now, I'm even going to talk about short-term direction. So we have here a lower low, right? That's a lower low from there to there. And so a lot of people would say, okay, well, even if it's not a long-term trend, at least it's a downward indication because you have a lower low, and therefore that is a bearish pattern. Again, wrong. Wrong. Why is it wrong? Sometimes I feel like a technical analysis heretic. Okay, well, that is a bullish pattern, actually, right there. That is a short-term bullish pattern. And the reason is because with trading, the devil's often in the details. One of the things I see with a lot of beginning traders is they learn the basics, and that's great. I mean, you got to start with that. They'll learn the basic meta patterns and so forth. That's cool. You're not going to make any money with that, but you start there. Where you make money is learning the details, the devil in the details. And for some of you, you've already probably picked up on this. So what we're looking at here, for example, is, let me bring up my horizontal line. And there's your low. Alrighty, and so yes, we make a lower low here, don't we? But this bar here, and some of you will recognize this candlestick pattern, that bar there, I'm not going to get all fancy with you, I'm just going to tell you what it actually means mathematically and also from a market profile perspective, which is based on auction theory, which I agree with 100%, by the way. I believe the markets operate as an auction. And so this candlestick here means that, yes, the market during this period of time, and this is a daily chart, so during this day, the market did make a lower low, but it opened and closed up here. So the overall sentiment that day, after all was said and done during that day, the market participants said, you know what? We tried these prices down here, and we couldn't get enough sellers. Not enough selling interest. And so for this day, we've actually decided that no, the market is being valued, the sentiment of the masses trading the market, we are valuing the market higher than this low. All right, or about equal to it actually, because the close is there. It opened it there and it closed there. But here is the point. So a couple pips above or below doesn't make that much difference. Here is the real part of the bar that makes the difference, is this long wick, or long shadow, if you prefer that terminology. That is called a rejection of value in market profile terms. Again, meaning that this whole price range from there to there, the arrow already drew, was rejected by the market. Rejection of value. So, what the heck, let's draw one more rectangular square. So, we tried to get down there. We did get down there. But by the end of the day, the market decided, nope, we can't get enough sellers. And therefore, that is actually a bullish pattern. Now, just short-term bullish, not long-term bullish, by the way. It's a short-term bullish pattern, even though it's a lower low. So, again, once I explain this, some of you who are more advanced are like, oh yeah, of course. But definitely for those who are beginners, understand higher highs, lower lows is not enough to look at. You have to understand the bars and what's going on within each bar, the bar pattern, and so forth. And so this actually ends up being a bullish pattern. As you can see, obviously, it does move up a bit. So this is why I like to use candlestick patterns, well, candlestick bars, and to see these candlestick patterns. So again, you'll see the same thing over here, by the way. Let's do one more real quick one, just because, again, it's very, let's see. You actually guys can't see that. Let me bring over my chart a little bit. Okay, so there you go. Now you can see it. So here we see it happen again. Okay, there's this low. So basically, support resistance, in one of my previous videos I explained, they are not lines, even though we often draw them as lines. They're really zones. And so these 5 bars here, 1, 2, 3, 4, 5 bars, all touched this lower support level. And therefore, I call that the flypaper phenomena, where the bars never broke below the level. So even though they made lower lows, this support level here still held. It's still considered that it held because we couldn't break below it convincingly. There's going to be a bit of noise or randomness in a auction place, such as a market like this that has so many millions and millions of people trading it. Same thing happens over here. So we test it again. Test that same. We're really testing the same support level. And now, again, we have 1, 2, 3, 4, 5, 6 bars that all touch that level. And then again, let me actually take that off just to make this extra last point here. We have this long wick that comes down here. And so even though technically, yep, we do close just a little bit below the low of this bar, doesn't really matter. That's within the margin of error, so to say, or not, that's not even the right word, just randomness of the market, chaos of the market. And the market again rejected the price levels below here. And so then from there, it goes up. I believe you can see that on the screen. So same dynamic. This is why it's so important to understand these just very basic even, just that very basic candlestick pattern can help you a lot. And always watch for that and understand that that is what's really meaningful, not a higher high or a higher low. So if you like this video, please understand that, sure, it's free. You got it for free here. But if you received value from it, then you actually have a moral obligation to pay it forward by clicking the share button and sharing it with other people, letting them know that, hey, this might be helpful for them as well. And if you're watching on YouTube, I love it when you click the thumbs up icon, and I especially love it if you leave a comment below, because that really encourages me to create more free tutorials for you. And also, I'm giving away one of my favorite trade strategies called the rubber band trade. I can't tell you how many people have had email me and thanking me for this, and I give it away for free, and there's people who thank me because they start making money with it right away. It has a very high win-loss ratio, so if you'd like that, I'll be happy to send you a video about that. It's only 26 minutes, and I'll give it to you for free. Just click the little image in the top right corner of this video. There's a little eye with a circle around it, a little image or something will be up there, or also in the description below the video there'll be the same link, and just click on that. Or if it's not on YouTube and you're watching this on my blog or something, then there'll be a link below or an opt-in form on the side. Anyway, however you do it, just send me a message one of those ways, and I'll email the video to you personally with the rubber band trade strategy.